Today I would like to analyze Pfizer, one of the largest pharmaceutical companies in the world and probably one of the worst performing stocks in the last years. If we're going to take a look at the stock price in the 5-year charts, we are down around 42%, and from 2022 we are down around 60%. So we're going to take a look at the financials to find out if this company is a good buy right now. The first thing we can recognize is a huge market capitalization of 126.7 billion US dollar. This makes Pfizer the 12th largest pharmaceutical company in the world by the market capitalization. We also have a dividend yield of around 7.63%, which is a very huge dividend, and this also did grow in a good rate in the last years as well. So we're also going to take a look if they can still pay this dividend with the current free cash flow. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 41.6 billion US dollar. This was a 1.8% increase from 2019, so a decent growth. Then in 2021, we had the incredible growth around 95%. Then in 2022, around 24% growth, which is also very good. Then in 2023, we had a decline around 41%. In 2024, we had a 7% growth. So overall, I think we had a decent growth in the last 5 years. So as a check here, and I think in 2021, we saw the incredible growth around 95%. So this was related to COVID. So then it also makes sense that in some years we see the revenue decline as well. The next thing we're looking for is free cash flow growth in the last 5 years, a very important number because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, we had a free cash flow around 12.1 billion US dollar. This was a 15% increase from 2019, so a decent growth. Then in 2021, we had a strong growth around 145%. Then 2022, we had around 13% decline. This is something we don't like to see, but it's understandable because the year before we had a strong growth as well. But then in 2023, we had a decline again around 81%. This is something we really don't like to see. But then in 2024, we had a strong growth again around 105%. So overall, we not had a consistent free cash flow growth, and we don't like to see that, so it's not a check here. If we take a look at the operating cash flow, we can also see a decrease in 2022 and also in 2023. What we can also recognize is the capital expenditures increased as well. This means the company investing more money into the business. So it's something we like to see. Actually, it's not a bad thing. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024. So this is around 9.84 billion US dollar. Then we're going to divide it with the current market capitalization, 126.7. So then we're going to get the free cash flow yield. This is around 7.76%. So this is something we like to see is over 4%. So the check here. And I think we can also pay the dividend with this. So this is higher than the dividend yield right now. But we can also see there is not much money left. So we don't like to see that. We would like to see that maybe 70% of the dividend. But this is way higher. So they pay most of the money they get from the free cash flow for the dividend. We don't like to see that actually. So I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025 the free cash flow could be around 17.89 billion US dollar. In 2026 around 18.17 billion US dollar. In 2027 around 18.8 billion US dollar. So I'm not sure if these free cash flow assumptions are realistic. So maybe we just take the number around 13 billion US dollar in 2027. So let me know in the comment if this number is realistic to you. So now we're going to divide it with the current market capitalization of 126.7 billion US dollar. So then we're going to get the free cash flow yield of around 10.20%. So this is a high free cash flow yield. It could be an indication for undervaluation, but this is only if the company can continue to grow the free cash flow. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take the long-term debt. This is around 57.8 billion US dollar. We're going to add the long-term debt as well. We can see here 3.2 billion, but we need to add this number as well, 3.78 billion. So round about 7 billion for the short-term debt. Then we're going to divide it with the free cash flow. This is around 9.84 billion. So then we're going to get the debt to free cash flow ratio. This number is around 6.58. So this means around 6 years and 7 months we're going to take to pay back the debt with the free cash flow. This is something we don't like to see. We like to see that number under 5. So it's not a check here. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 20 billion US dollar. So this is a very high amount and we like to see that. So I think this makes the balance sheet look better. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number is, the higher the indication for undervaluation. So what we're going to do now, we're calculating the enterprise valuation first. So this is a market capitalization 126.7. So we're going to add the debt. So the debt is around 64.8. We're going to take minus the cash, 20.48. So then we're going to get the enterprise valuation. I'm going to calculate this first. So the number we get for the enterprise valuation is round about 171 billion. So this is how much the company is worth. So this includes the debt and take minus the cash. So it's more accurate for me. Then we're going to divide it with the current free cash flow. This is around 9.84 billion. So then we're going to get the ratio that we're looking for. The number we get is around 17.38. So this is under 25. So this is something we like to see as a check here. And this could be an indication for undervaluation. So we can also calculate this number with the free cash flow assumptions for 2027. Then we would get a different number. So let's calculate this as well. So the number we get would be around 13.15. So this is a great number. We like to see that. And I think this can be an indication for undervaluation. But of course, we don't really know if they can make this free cash flow of 13 billion in 2027. So if you believe the free cash flow can grow, I think this company could be a good buy right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look now and we can see actually in the last years the shares outstanding did increase. So this means the company puts more shares on the stock market to get the better financials, to invest the money probably in the business again. So it's not a check here, but I think it's also understandable. They do not have a very great balance sheet. So I think to buy back their own shares is something they should not really do at this moment. I would like to give my conclusion about this company. So let's start with a positive. So I think we had a decent revenue growth in the last 5 years, but it was very inconsistent as well. The free cash flow yield around 7.76% is also looking quite good. It could be an indication for undervaluation. So if the free cash flow can continue to grow, maybe in 2027 the free cash flow yield could be around 10.26%. So then the enterprise valuation to free cash flow ratio around 17.38 is also looking quite good. This could be an indication for undervaluation. I like to use this ratio as a valuation system. Then in 2027 this ratio could be around 13.15 if we can continue to grow the free cash flow. So this is also looking quite good. Then the debt to free cash flow ratio around 6.58 is quite high. This is something we don't like to see. I think they have a little bit too much debt. So they have a good amount of cash, 20 billion in the bank. This is a lot of money, but I think they're going to use this money to buy other companies or to invest in the business. So then we have a dividend yield of around 7.63%. So this is quite high, and I think in this case it's not a good thing because the free cash yield right now is around 7.76%. So they not have much money left to pay the dividend, and I think it's not really a good scenario. Also, the free cash flow growth in the last 5 years was very inconsistent, something we don't like to see. So I think this company can be a good buy right now, but only if you believe the free cash flow can grow. And if the free cash flow might decline in the next years, I think this company will probably cut the dividend as well, or they will get more debt. This is something we don't like to see. So there's definitely some risk involved. If you believe this company can make a comeback, let me know in the comment. If you found this video helpful, don't forget to like and comment and subscribe for more content.